All right, let's talk about something huge happening in the world of finance right now. Seriously, whether you're trying to raise money or invest it, the rules of the game have completely changed. So today, we're diving deep into the new playbook for private credit and what it really takes to get a deal done. You know, this single quote right here, it gets to the absolute heart of everything we're talking about. The money is still out there, for sure, but confidence, that's what's in short supply. Lenders aren't just being cautious anymore, they're demanding a whole new level of proof. If you can understand this one shift, you understand the entire market right now. I mean, think back just a few years ago. The mantra was so simple: growth at all costs. Capital was cheap, it was everywhere, and the only thing that mattered was speed. Well, that world is gone, completely. Today, the game is all about durability and downside protection. It's not about how fast you can grow anymore, it's about how well you can survive a storm. So let's break down exactly why that old playbook has been totally tossed out the window. There are some massive market forces at play that have completely reset the entire financial landscape. Okay, the biggest driver of this change is something called the maturity wall. Picture this: a massive tidal wave of debt that companies took on back in 2020 and 2021 when money was basically free. Well, that wave is about to crash. All that debt has to be refinanced, but at today's much, much higher rates. And here's the kicker: traditional banks are backing away, which is creating this huge financing gap. And into that gap, that's where private credit steps in. But this new reality comes with a new gatekeeper. The filter that all capital has to flow through now is a process called underwriting. And believe me, it is the absolute key to this new environment. So what exactly is private credit underwriting? Well, you can think of it as a forensic deep dive. It's a process to figure out the real risk of a loan. We're not talking about the standardized check-the-box approach of the big banks. No, this is a fundamental, bottom-up investigation into the very DNA of a business. And this process goes so far beyond a simple checklist. I mean, underwriters are validating every single assumption you make. They are stress testing your cash flow against worst-case scenarios you haven't even thought of. Why? Because their number one goal is capital preservation. Here's the thing to remember. In this market, deals don't fail on price. They fail when the story falls apart under this kind of intense scrutiny. Okay, so if you want to navigate this new world, you absolutely need the new playbook. And it's built around a classic framework, the 5 C's of credit, but with a modern, way more demanding twist. So here they are: character, capacity, capital, collateral, and conditions. Let's break them down. First, character. How did the management team actually perform during all the recent chaos? Next, capacity. Can the business really afford to pay this loan back at today's higher rates? Then, capital. How much of your own money, your skin in the game, is in this deal? Lenders want to see a significant cushion. Fourth, collateral. What are the hard assets backing this loan? And what are they truly worth today, right now? And finally, conditions. How resilient is this business? Can it handle a recession or other major economic shocks? Theory is one thing, but let's make this real. Let's make it tangible. We're going to look at 3 totally different real-world scenarios to see how this intense underwriting process is actually applied in practice. First up, imagine a mid-market company that wants to buy one of its competitors. Now, a traditional bank might see a recent dip in profits and just say no, flat out. But a private credit underwriter, they look deeper. They're going to analyze future sales contracts, figure out how the combined companies can save costs. They're focused on the long-term health of the business, not just one bad quarter. Okay, now let's apply this same thinking to real estate. Let's say a developer needs a short-term loan for a prime building. The underwriter's focus here is going to be laser sharp. They want to know, what is this property worth today, not in some hopeful, speculative future? And is there a clear, believable plan to sell it or refinance it in the next 12 to 24 months? Speculation is out, certainty is in. All right, our final scenario is a private equity fund that needs a loan, and they're using their entire portfolio of companies as collateral. Now, in this case, the underwriter isn't just looking at one business, they're looking at all of them. How diversified are they? Are they all in the same industry, or are they spread out? The whole goal is to make sure that if one company fails, the entire loan isn't at risk. It's all about the collective strength of the group. So, we've covered the why and the how. But the most crucial question is, what does this all actually mean for you? So let's talk about the so what. Here's the actionable advice for both sides of the table. If you're a borrower, if you're out there looking for money, the message is simple. Get ahead of the tough questions. Be brutally honest, because bad news never ages well. And be flexible.
Now, for investors, your homework is to scrutinize the lender's process. Are they really disciplined? Also, spread your investments out and demand loans that have real protections, not those old covenant-light deals that offered almost no safety nets.
And really, it all comes down to this one idea. The era of easy money, of just showing up and getting a check, is over. Success today hinges on a deep, fundamental respect for the discipline of underwriting. Master this, and you're going to thrive. So the question to ask yourself is, are you just a tourist in this new market, or are you a true practitioner? Thanks for joining us.